I think to understand why I turned bullish on inflation, you have to understand why we had disinflation for the past 40 years. And basically, it was cheap capital, cheap labor, cheap goods. These were the three engines of the great disinflation. Now, if I look at it today, they're all kind of breaking down at the same time. So these, to me, are the structural drivers of inflation. And this is the reason why I think inflation is secular. And these are things that the Fed cannot really do much about.
All right, everyone. Welcome back to another episode of On the Margin. Today, I am joined by Vincent Deluard, who's a global macro strategist at StoneX. Vincent, welcome to the show.
Thanks so much. It's a pleasure to be here.
Yeah, absolutely. It's the first time I've heard your voice on many of my favorite macro podcasts, so it's a pleasure to get to do this in person for sure. So I would love to, we were sort of talking before we got on here. What I'd love to kind of do here is tease out both your sort of cyclical, shorter to midterm view, and then I would love to kind of get your secular and long-term view on just your kind of overall macro framework. So, markets have had the pleasure of digesting a whole bunch of economic data this past week or so. We've had a CPI print that came in a little bit hot, at least on a year-over-year basis, a hot PPI print, strong retail sales. I guess my question to you is, do you see things kind of heating up again?
Yeah, I do. And that is it's not a surprise to me because I've always been in the camp that the economy is much harder than people think. And it's going to take a lot more to slow it down, that kind of dovish people narrative had. But now the data is here and the market has to awaken to the fact that, the economy is still creating 500,000 jobs. We are seeing things that actually surprise even myself, like things like used car prices are going back up, stabilization in the real estate market. And it could be that actually Q4 was a semester, maybe not reacceleration, but certainly stabilization of growth. Inflation fell. Wage growth is very strong, so people had more disposable income in Q4. We still have all these, animal spirits, speculative juices in the market, which, you see that in Solana, Carvana, Bed Bath & Beyond. So to some extent, financial conditions ease a lot, despite what Powell seemed to have said in the last press conference. So we're kind of back to where we were earlier in the summer, except that now we have a Fed funds rate which is, on its way to 5%.
It's been funny actually, even just this past week or so, when this kind of stronger economic data came in, you saw yields on the 2-year, for instance, creep up. The 2s and 10s, continues to descend further and further into inverted territory. And I think the terminal rate is sitting right around 5.4% now. At the same time, though, we've seen stocks actually hold up and respond relatively positively. That seems to be conflicting data. What do you make of that?
I think it's just the everybody was positioned for a half one recession, half one to 2023. I like to read the investment outlooks, not because they're interesting, because most of the time they are not. People will expect, like stocks are going to go up with some volatility, and you should buy quality stocks with a good dividend. Thank you. But this year, I want to use it to get a sense of what is the consensus view among people who watch markets, and going into 2023, you had this extraordinarily, unusually strong consensus that we're going to have a recession, bonds were the place to be, value over growth, emerging over US, and of course, when everybody's one-sided, it doesn't take all that much to kind of flip. Create some drastic moves because everybody has to switch back. So people had to reposition for the fact that, maybe we're not going to have a recession in the first half. I would argue we may not even have in the second half of next year. I mean, it's possible, but I just don't, we'll see what the data says. But at this point, it's too early to say that. Everybody was positioned for value to outperform growth. And of course, the exact opposite happened. It's one of these in my view, it's a very vicious counter-cycle move. It's the law of maximum pain. and I suspect we are somewhat at the point of maximum pain. Now we've gone through this portfolio rotation process. Yields have come up quite a bit. And I think we are getting at the point, as we've seen in recent days, when good economic news is bad news for the market again.
Now, Vincent, I'd be curious, like, what do you attribute this sort of pickup in economic activity to, right? Because it's to me when I'm trying to parse it out, it's a little bit muddled because some of the forward-looking data actually looks pretty bad, right? But now we're kind of looking at, like you said, like used car prices bouncing again, strong retail sales. On kind of the other side of the world, we've got the China reopening. So there's a
Right.
little bit of discontinuity in between central banking policies. Like, I'd just be curious, like, how do you sort of parse through these sorts of conflicting, often at odds indicators?
Well, I think you had two huge, objectively positive surprise for global growth. One
Mm,
is Europe did not freeze to death. We did not even have a recession in Q4 in Europe. I mean, by the smallest increment, but I think it's 0.01% growth, which no
okay.
one expected that, right? Remember, go back to the summer nat gas price. Europe is going to deindustrialize. We're going to freeze to death. We're going to
Yeah.
we went from like basically Europe is going to go back to the Stone Age to I mean, I was in France 2 weeks ago. I mean, everything's normal. I mean, people are grumpy, they're on strike, but other than that, everything is normal, which actually it is normal too. So Europe is okay, and it's a lot of luck, right? Warm weather, good storage, whatever. But it's holding much better. And then you have the China reopening. So I mean, if you think of the economy as four buckets, right? The global economy: U.S., Europe, China, and everybody else. U.S. is more resilient than what we thought, and I'll get into this later. Europe is not dying, and China is reopening, which lifts by extension the Australias, the Canada, Brazil, all of these places that are leverage play on Chinese growth. So you had a positive shock to global growth, objectively, something that people did not see going into the quarter. And then the second part to the strength is U.S. resilience, which I always thought was underestimated. People underestimated the resilience of the consumer, the wage growth, and how much of the COVID stimulus is still running in the system. People always thought, oh, we have, 4% rate is going to break the economy. Because they kind of remember what happened in late 2018 when the Fed had, like as soon as rates went up, and then when we had the repo market freeze. There's this view that there is that level of yield that will just break everything. And that level of yield has come up. Why has it come up? Because nominal GDP is 40% higher than it was 3 years ago. We are in a much better spot to tolerate higher yields because people have deleveraged, because nominal growth is much, much higher. I mean, yeah, if you have about 10% nominal GDP growth, which is what we have, 5% Fed funds rate is not restrictive. It was restrictive 3 years ago. It no longer is. I would argue, stimulative.
Because one of the things that, to exactly your point, that end of 2018, early 2019 period where Powell famously pivoted and we got the phrase the pivot, that was kind of, people were looking at that level at the 10-year. That was about 2.5 or 2.8%, right? And we've sort of blown past that. To my surprise as well. I'm surprised we haven't seen more stress. There's a little bit, the gilt market had their little stumble a little while ago, but largely things have been okay. And you had there was a great interview, I think, on Odd Lots recently. Steve Eisman kind of came in and said, actually, the U.S. banking sector is pretty rock solid, and honestly,
Yeah.
Treasury market also pretty rock solid.
And
Are you
and for him to say that, knowing his history, I mean,
right?
I think you should always pay attention to people who have made one call in one direction and are making the opposite call. I mean, because that his bias is going to be on the other side.
Yeah, absolutely. So that's exactly why it stuck out to me. So to be honest, it kind of seems like everything feels relatively solid. I'm not sure if this is so much of a question to you as a statement that it's been surprising to many, and I guess that fear has kind of subsided that we're going to see some kind of break in liquidity in the treasury market or something like that. But
Yeah. So something that that helped a lot, which is going to switch, is dynamic of the TGA, right? So Treasury General
yeah,
Account is the government checking account, the Fed. So when you draw money from the TGA, you're injecting liquidity in the economy. Now, because of the debt ceiling and because of the fact that TGA had been replenished by about $1 trillion 6 months ago, we've been able to draw that down. So if you look on a net basis, TGA minus the Fed's balance sheet, you had more money leaving the TGA than you had quantitative tightening. So if you consolidate the public sector, which I think you should, and it's kind of the MMT view that the Fed and the Treasury are two sides of the same coin, the public sector had been injecting liquidity on a net basis into the economy. Now, of course, this cannot go on forever, right? Because QT is going to keep coming at 95 billion a month until Powell changes it, but so far he's not talking about it. While the TGA, once you hit a very low balance, you have to refill it. So that I think that's one of the reasons why I expect this kind of big impressive move to lose steam, and I think we're already starting to see some of that right now.
Yeah, absolutely. So when we're talking about liquidity, you kind of just picked out two of the three factors that at least I pay attention to. The TGA Treasury General Account, kind of like the checkings account of the United States government, the Treasury. When they're spending money, it's liquidity positive. Then there's the Fed's balance sheet, but then there's also the reverse repo, right? And that is another, there's still a lot of money that I think it's $2 trillion or so that's in the reverse repo facility. If that were to leave, right, I think the Fed knows that that's in that kind of has that in their back pocket that if that were to leave, that's liquidity positive as well. Could you, Vincent, I don't know how much you are familiar with reverse repo, but can you just talk about how you think about that? And I think one of the Fed governors recently mentioned that they consider funds that are in the reverse repo to be a part of the banking system. Could you help disentangle that concept for us here?
Well, so just to walk back maybe for the audience, reverse repo is a facility where if you have excess cash, you can give it to the Fed, and then you'll earn basically the repo rate, which is close to the deposit rate. The people who use that the most are money market funds because they collect everybody's cash. So what they've been doing, and I think it's somewhat disturbing, is instead of buying bills, they just put the money in cash at the RRP because net it was just easier, simpler, and they were the yield were comparable. I think what the Fed wanted when they started QT, they wanted the reverse repo to be drained. Instead, what we've been seeing is the drainage has come from bank excess reserves. So hopefully going forward, that will come. There's this big question about how much excess reserves we need. That's a question that no one has the answer to. I think the New York Fed has come up with a paper about a year ago saying they have 2 trillion. They think 2 trillion excess reserve is what they want to get to. Now the question is, do you include the reverse repo in that number or not? And if they want to include that number, that means that excess reserves are much higher. And as a result, they need to shrink the balance sheet a lot more to get where they think liquidity should settle over the long term. But again, these are all soft numbers. No one really knows for sure. And then there's also this question about excess liquidity. My impression, and actually on this, I'm totally in agreement with Fed guy Joseph Wang, is nature abhors a vacuum. So excess liquidity which may have been excessive 3 years ago, is no longer excessive. People find a use for it. If you have cash, that's the nature of Wall Street, right? If you have a big pile of money somewhere, eventually we'll securitize it, we'll lend it, we'll short it, we'll borrow it, whatever. We'll do something with it. So my suspicion is that some of that excess liquidity that was indeed excessive 3 years ago is actually not excessive. And maybe we'll run into liquidity problems faster than we expect. And that would be one of the reasons to be cautious on the stock market. I don't think we're out of the gilt market, like the things we saw in earlier last year when we saw liquidity being a constraint. I am still more worried about liquidity than I am about the economy.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. So let's maybe zoom out here, and I actually want to rewind the clock back to late 2020, early 2021. you were kind of very early and very loud, I would say, in calling for inflation, or at least that people should be worrying about it. This was at a time when there was no appetite on Wall Street or anywhere else to hear that prediction.
Trust
What
me, I
gave you
know.
the confidence? I know you know. What was your framework like? What gave you the confidence? What did you notice that or pay attention to that no one else did?
I think to understand why I turned bullish on inflation, you have to understand why we had this inflation for the past 40 years. And basically, it was cheap capital, cheap labor, cheap goods. Uh, I'll go very briefly because cheap capital, we had these massive excess savings from Europe because of the launch of the euro that created this huge trade surplus in Germany, Switzerland, etc. That could not be reinvested domestically. I mean, they tried a little bit, with the pigs, and sovereign debt crisis blew that up. So then Europe was generating about 500 billion in surpluses that were finding their ways into the U.S. Treasury market and U.S. assets. You had a similar situation going on with oil producers, OPEC, building all these massive reserves, sovereign wealth funds, and so forth, all flowing into the Treasury market. And then on top of that, you had China joining WTO in 2000 with an artificially cheap exchange rate, and then they had to build reserves. So you had these three savings glut, like rivers feeding into the US Treasury market. And that was almost like gravity. I mean, if you look at a chart of the 30-year yield since 2000, just down, 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 as if a force was pulling it down. That's the first reason. Second reason, of course, is cheap goods. Everybody understands that. China opens up. So you have 1.4 billion people economy, super cheap exchange rate, good infrastructure, huge demographic bulge. I mean, this was just, if you look at the US CPI, and I think that is very important. I think we had two CPIs for a very long time. We had this artificial CPI at about 2%, but really that was a product of what I would call the US service CPI, which was running at 5%. So the US service CPI is things like healthcare, things like higher education, things like the cost of a ski lift ticket at Lake Tahoe, things like haircuts, but anything that was using American labor was going at 5%. And then you had the Chinese CPI, things like TVs, toys, electronics, garments, and more things as the Chinese economy diversified, which was actually dropping in price. And on average, that gave you 2%. But I would argue that 2% was fictitious. The real underlying inflation was already at 5%. We just didn't see it because we had this massive shock from China through the Walmart supply chains and then eventually Amazon. So that's on the good side. And then on the labor side, we had in 1995 the tequila crisis in Mexico. Suddenly, the Mexican peso lose 90% of its value. And over the next 10 years, you have 10 million Mexicans crossing the border. And these are young men, hardworking. They come in, ready to work, and huge downward pressure on wages. I mean, minimum wage hasn't increased in 40 years because of that. So you had these were the three engines of the great disinflation. Now, if I look at it today, they're all kind of breaking down at the same time. On the capital side, well, Europe no longer has a trade surplus, neither does Japan, or at least it's shrinking very rapidly. And we're going to need our own savings in order to mobilize them to rebuild an army and pay for our retiring boomers. So European and Japanese will no longer be financing the shopping habits of Americans. Of course, OPEC, Russia, China are no longer buying US treasuries because they don't want to, and even if they do, their assets can be seized by fiat. So that's gone. And on the good side, trade wars, China is aging, friendshoring, all these things. I mean, that pool of Chinese labor anyway shrinking. I mean, the working age population of China peaked 10 years ago. Now it's the actual population that is shrinking, and it's going to shrink massively because of the one-child policy, right? Every 25 years, Chinese population is going to almost halve. So we will no longer have access to this seemingly infinite pool of highly qualified, hardworking workers. So that's gone. And then on the labor side, you actually had negative flow from Mexico for the past 10 years, and that accelerated with COVID. So these, to me, are the structural drivers of inflation. And this is the reason why I think inflation is secular. And these are things that the Fed cannot really do much about. I mean, if anything, it can hike rates and send the economy into nasty recession, but why? I mean, it's like, trying to swim upriver at this point. For 20 years, the the current was disinflationist. So it was very easy for central bankers to hit the 2% target. They had nothing to do. They could look at other things like, oh, let me target the price of the S&P 500. Let me target climate change, racial equity, because it was easy. Like the inflation was going on its own. And now we're moving to a new environment where instead of swimming downriver, they're swimming upriver. And they will find that just, the cost of keeping that 2% target is prohibitively expensive. And my expectation is that they'll put up a fight because, nobody gives up without a fight, which is where we are right now. But then after some time, they'll be like, hey, listen, this is too hard. We don't want to break the labor market. We don't want to have 10%, Fed funds rate. We don't want to have massive unemployment. We're just going to go with it and accept that inflation is structurally higher. Again, there's this concept that I like to, people talk about R star, right? The natural rate, on the economy, whatever. That to me, that is like, okay.
Can you explain
like
what that is, Vincent? Can you
Yeah,
just, because the Fed pays
yeah.
attention. Yeah.
Yeah. If you're Catholic, it's like the Holy Ghost at Mass. So it's there, but nobody can see it, but you have to trust that it's there. And you have to trust the man with the authority who tells you that it's there, because you can't see it. But the Fed people can spend hours writing papers about it, and no one can call them on it because no one knows what it is. Supposedly, it's the natural level of interest rate of the economy that is neither accommodative nor restrictive, but you can't see it. I think that's somewhat of a useless concept. What I like to focus more on is the I star. So there will be the optimal level of inflation. And I believe that is something that exists, that no one pays attention, but that is different in every decade. And I would argue that there was a natural level of inflation in the 2000 and 2010 that was, let's say, maybe 1.8% in the US and 1% in Europe, 0% in Japan. It was just falling for the reasons that I was highlighting. And now that I star is kind of rising. And it seems to me that it would be a lot easier to just accept that rather than fight it.
So much to unpack there. First of all your reasons for why, the secular inflation thesis in 100% agreement. I think there was a longtime listeners of the shows will know I've referenced this speech a lot. Sir James Goldsmith gave a great speech on Charlie Rose in 1995, actually about inducting China into the trade alliance. So we'll link it in the show notes, but you should highly recommend you go listen to it. I noticed that a lot of the times when people are talking about in a secular inflation view, demographics and debt comes into that. I noticed that you didn't include either of those two factors. Do you think about that in terms of the long-term secular inflation thesis?
Absolutely. I think ultimately inflation is the
solution.
Is the solution, and it's a trade-off between generation, and it's tied with this issue of debt, because inflation is effectively a way, the most pleasant way, if we're not experiencing Venezuela-style inflation, to effectively default on the owners of debts and the owners of assets and transfer income to the young, the working, and the poor, which is why I believe that fundamentally inflation in a controlled way is a good thing. We have run for 40 years on building more debt on top of more debt, solving it with lower interest rate, higher asset prices. And that has effectively been a transfer from the working, the poor, and the young to the idle, the rich, and the old. And as you do that, you reduce your trend growth. This is a problem that Europe has, Japan has. You have this very aging population, high level of inequalities. No one's buying homes, no one's making babies, so growth keeps falling. At the same time, your stock of debt keeps rising. So the income that needs to support this expanding pile of debt is shrinking and shrinking. Now, how do you solve that? Well, at first you just drop the interest rate, right? But we reached a logical non sequitur. We had 16 trillion of negative yielding debt. Okay, you can't go any lower, all right? You had the Bank of Japan telling you, I'm going to yield curve control to zero all the way out. That was your signal. This cycle cannot go any longer. This is completely stupid. You are buying a bond where you lose money because you think that there will be a greater fool that will buy it so that he lose even more money. I mean, this was absurd. So you needed some sort of a deus ex machina. Like in theater plots, you get the guy who comes in the middle and changes everything. That was it. That was inflation. Inflation does that. It will, we had nominal GDP expand by, 12% in the past, in 2021 and 2022. That does wonders for your pile of debt. I mean, that means that suddenly you're able, if NGDP is expanded by 12%, you can run fiscal deficit of 6-7%, and still shrink your debt to GDP ratio, which is exactly what the West is going to need in the next decade. We know we're going to have higher social spending, higher healthcare spending, higher military spending on top of that. So it's very hard to see how deficits will shrink. So if deficits cannot shrink, you need nominal GDP to expand. Now, can we increase real growth? Maybe ChatGPT can change the world, whatever. But the best known way to increase nominal growth is to increase increase the price level.
Yeah, Vince, it's really interesting that you say that. I mean, we so I've been noted again on the show, but the Congressional Budget Office that puts out sort of projections, right, has been projecting a $1.6 trillion deficit over the next 10 years. This Wednesday, they actually updated that. They said no, it's not going to be lower. It's going to be $2 trillion a year over the next 10 years. So, but this year it's going to be slightly better. So it's only 19 over the next 10 years. I mean, when you really, there's kind of a lot of talk about how government financing is different from household financing. And yes, that's true to a certain degree. But at a certain time, your sort of tax receipts, your revenue kind of runs into your real obligations that you as a country can't print. Maybe that's, Medicare or healthcare services that you promise or entitlements or whatever it is. And the point I'm trying to get to is like something's got to give. If you're kind of in a seat of power, like you have to find a way to basically soft default, right, on the obligation because you have a non-sustaining system. And I'm basically, this is my long-winded way of saying I agree with you. I don't personally see a way out outside of just inflating things away. Now, that being said, like when you look at previous generations or periods of time, that's not always a super fun process. So like, can you get a little bit more into the nitty gritty? Like if that's kind of your projection, what does that actually look like kind of on the ground?
Let me before I do that, let me just
Yeah.
mention one thing on inflation and tax receipts. So one of the reasons I've been bullish on the economy is that I don't really pay all that much attention to GDP and non-farm payroll. What I track is tax receipts because tax, it covers everybody. Everybody has to pay and hates to pay taxes, and you can find them on a daily basis on a website, daily treasury statement. And this has kept me on the right side of the economy for the past 2 years. I mean, we had this explosion in tax receipt, growing by 15% year over year with the same tax law. So it's not that we increased. No, what was happening is that strong growth, strong inflation, and bracket creep, right? Because as the economy expands, people switch from a high tax bracket. So tax receipt grow faster than the economy, which is one of the ways that the stealth inflation bailout works. And one of the reasons why, if you're running a government, you don't want to break that thing because it's a golden goose, right? And if you are going to, have this increased spending, you need the collection to keep up with that. And so far, it's been doing that. So that was my point on taxes and inflation. Inflation bails out government even more so than it bails out the private sector because of the private creep effect and bracket creep effect. And it's been doing that for the past 2 years, and it's still doing that. And you look at tax collection so far in the first, it's slowed a little bit, but we're still looking at plus 9-10%. So it's pretty impressive. I mean, these are China-like numbers. That was the first thought. And then the question that you mentioned, how does that look like? It depends who you are. The past 40 years have been fantastic for old, rich, retired asset owners generally, and corporate margins. These are basically we've had this historic transfer from workers to capital owners, from the young to the old, and it's been a fantastic era for our industry, right? The 60-40 portfolio was up 9% every year. You really need to be all that smart. I mean, if you were a smart guy, you did risk parity, which I know I'm going to get some blowback here, but yes, it is leveraging bonds. Okay. Functionally, risk parity is, a 60-40 portfolio where you increase the allocation to bonds because it has volatile. So you could do a lot of, you could be on the golf course at 3 p.m., collect a management fee and just retire. And we had, generally the financial service industry thrived during this period. Now, the categories that were not doing so well were the young, the poor, the working, who were cut off from the property market, faced stagnant wages, and generally could not acquire assets. I expect the next 20 years to be the exact opposite. So the pain is going to shift for corporate margins. Corporations obviously benefited a lot from cheap capital. They could relocate factories in places where labor was really cheap. They had generally a very supportive environment. Corporate income tax rate got cut. Antitrust was no longer applied. So you had this extraordinary increase in the share of wealth that goes to corporation to profits. And then the last part, of course, is going to be traditional 60-40 portfolios, which work so great because inflation was not there, because we had no inflation. You had a negative correlation between stocks and bonds, and you had this fantastic situation where you basically got paid to hedge an equity portfolio with long-term treasuries. I mean, this is an option that pays you. It's fantastic. As this unwinds, this is going to be very painful for asset owners. The best analog, and I'm sure you won't be surprised to hear me say that, would be the 70.
Yeah, absolutely. So my question, one something that people say when exactly what you just said, right? That inflation actually is kind of a transfer, right, from capital owners to people who provide labor, and typically that tends to correlate to like old to young, right? Because it's the old people that have the assets, and it's the young people that typically do the labor.
Especially now.
Right. So, something that you also hear said about inflation quite a bit is that it's the worst kind of tax because it's a tax on the poor, and the costs are outstripping the prices of wages. What would you respond to that?
I don't want to give an absolute answer because I think inflation is a very broad phenomenon. It's kind of like
Mm.
a fever in the body, right? You can have a fever for a bunch of reasons because you got a cold, because you have cancer. I mean, so he's saying inflation is any sentence that starts with inflation is always and everywhere is going to be wrong, right? I mean, it's not always and everywhere monetary. It's not always and everywhere fiscal. It's not always and it's complicated.
Mm.
Inflation is always and everywhere complicated. I'll go with that. So my answer, what you describe is possible. It happened before, and I mean, I travel a lot to Latin America, and whenever I make my pro-inflation case, I mean, clients are sympathetic with me because they've experienced inflation and they know they see the signs, but they follow me on the inflation side, but they don't follow me on it. But it's going to be a good thing part because they say no, inflation is how you destroy the middle class. And the story of Argentina, Brazil to some extent, and then you have this kind of well-connected class at the top that benefits from it because they can hide assets in US dollars or condos in Miami, and that is indeed a tax on the poor. So it can be. I'm not saying it doesn't exist. What I'm saying is the inflation that we're experiencing right now is very different. It's inflation that's coming from the bottom to the top. Uh, the areas where we are seeing the strongest job gains are for people without college degrees, paid hourly, minority, um, low income. If you look at the Atlanta Fed data, you can look at the wage gap between, quintile. The strongest job growth is there. So you actually see the bottom layer is actually you are seeing on average wages are kind of keeping up with inflation. Now we basically at 6% on wage growth, 6% inflation, but that 6% is not equal distributed. In a reversal of what was happening 20 years ago, the Google employee, the product manager at Meta, who does TikTok showing how she eats avocado all day long and goes to the yoga room, is getting fired, or their stock options is worthless, and you are seeing wage gains at the bottom end because that's where we have the shortage. Fundamentally, the problem in the U.S. labor market is we have a shortage of healthy young workers that are willing to do hard jobs, hard physical jobs that cannot be automated with ChatGPT, and where I would argue a lot of these jobs were done by illegal, undocumented migrants who are no longer there. Now we have this very small generation, Gen Z, that's entering the labor force at the same time as you have a very large generation, boomers coming out. And we realize with horror, we just don't have the bodies. On top of that, you add the fact that we have obesity, anxiety, all these connected issues that reduce the supply. And you see that there's this mismatch in the labor market that's not being solved. Like firing a bunch of Google engineers is not going to give you more
Right.
roofers, more plumbers, more truck drivers, more farmers. So I think we can have this inflation actually be redistributive. It certainly is redistributive if you think of the ratio of asset prices to labor. That's one of the
Yeah.
charts that I always feature. I love it. It's S&P 500 divided by minimum wage. Tells you how much you need to work, how many hours you need to work to buy one share in the index. 40 years ago, it was about 4 days. Now it's 4 months. So if you think in terms of people trying to convert their labor into assets, which is what you want to do as a young person, right? You got not unless you're a NYU trust fund baby, you got nothing. All you have to do is your labor, and typically it's not worth much because you start your career, and you want to convert your labor so you can buy a house, have a 401k, whatever. That cost has been getting harder and harder for 40 years. And finally, last year, it went down. The price of every asset went down by 20% or more. Wages, at least nominally, increased by 5%. I think this is what we're trying to fix right now.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the two co-founders of Robinhood, Vlad Tenev and Baiju Bhatt. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you will get 10% off on a ticket. Again, that's Margin 10 because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. Vincent, can you kind of key in on that? Because that, again, I think that's a super important. So the amount of dollars, days of minimum wage to buy one share of the S&P, the sort of median income and over median price of a house over median income, all that sort of stuff. I think there's kind of a generational component to that, actually. And you have a great quote. I'm going to pull this out. I believe that the capital markets are still progressing along the long arc prophesized by Neil Howe's fourth turning, the rise of secular inflation, the breakdown of 60-40, and the eventual rejuvenation of American institutions by a new generational contract. So we've talked about a lot of that, right? We've talked about your secular inflation thesis. We've talked about 60-40 and the trouble that that's going to have. Talk to me about the last part of that statement, the rejuvenation and the creation of a new generational contract. What did you mean by that?
I mean, again, I'm going to give credit where credit is due. Neil Howe and Strauss, fantastic book. I mean, there's something. So if there's a book you need to read every 5 years, and every 5 years you're going to be blown away by more stuff. This is, fourth turning. So they're the ones who came up with the term millennials and the generation, and really thinking of history as a repetition of generational cycles. And they have this concept of, every 180, basically every 4 generation, you have a major turning. Like you have to basically get rid of the old so that the new can emerge. And according to their forecast, and this was written in the mid-90s, and they have everything is there. Big financial crisis, rise of populism, inflation comes in. All that is basically the social body trying to regenerate itself as one generation passes the baton to the next one. So in our case, it's a boomer generation, or the boomer plus silent, and you can see it it's clinging. It's a very clingy generation. The reason it's so clingy is because it's so large, right? So the boomers, by virtue of their size, had an unusual level of control over economic, political, and cultural institutions in the U.S., and they still do. And now, the way I picture that is Nancy Pelosi holding her little crab, they're not going away. Actually, I see Dianne Feinstein said that she's not gonna run again in 2024.
Yeah.
Anyway, but you see that when median age of Congress has exploded. You see this kind of gerontocratic rule. But of course, that in the next 10 years, we have physical limits to how long Nancy Pelosi can hold on to her gravel, or Joe Biden or Donald Trump. It's not a political statement; it's just a generational one. So as this generation kind of passes, this generation is holding the assets, right? By and large, the mass majority of U.S. assets is owned by the boomer generation, unusually large share of the assets. They need to pass these assets down to Gen Zs and millennials. Now, the problem is the assets are, I would argue, still valued for the very low rates environment in which we lived in. So This is your, every house where in my neighborhood in California where I live, it's nothing under 1.5 million, right? And then you look at the income of the people who are supposed to buy these houses, it just doesn't work, right? It's the whole millennial cannot buy a house, and then you have the best big story. You should stop eating avocado and then you'll be buying a house. No, that's not the problem. The avocado is not the problem.
Yeah.
So we need a process where the value of these assets are written down and the value of wages is at least nominally increased so that we can transfer these assets. That's what's happening right now. And as we do that, there will also be a shift of power. We need to clear a lot of institutions that no longer make sense. I mean, we still live in the world that was built basically after the end of World War II. And we see it, I mean, everywhere. If you look at, the rise of China, what's happening with Russia, Ukraine, changes in warfare, you see that world is creaking. The institutions that we have are not set up to address the challenges that we face. And hopefully at the end of this 20-year process, which let's say started in 2008, you'll come up with a new social contract with a new generation in power and with new institutions. And I think that will set the seeds for new prosperity.
Mm. I tend to agree with that. It's and even over this sort of COVID period has been, there's been distrust. Like you can kind of trace these sort of flashpoints, right? Like 2008, that was kind of distrust in the banking system, especially by the younger generation, who kind of grew up thinking they're a bunch of crooks, which I don't think is really fair, but there's a popular belief. And then COVID, you saw distrust in kind of in some of like the healthcare sorts of institutions, the WHO, that sort of thing.
Science itself, rational thinking, from both sides. I'm not making I'm not saying it's the anti-vaxxer, but on both sides you see this kind of rise of religious thinking, which again is kind of a magical thinking. It's a sign of it. You saw that in the Middle Ages, like at times, like revival. Let's burn the witches. I think we had some of that during the COVID lockdowns.
Oh my gosh, yeah. I mean, look, it was because it was on both sides, and there were some people who like kind of flagrantly wanted to disregard any sort of experts, and then there was another group of people that kept invoking the name of science without like really practicing it in an honest way. It was both sides, and then even like media, right? I mean, Trump and his whole fake news campaign, honestly, I think did a decent amount of damage and probably highlighted some systemic biases that people knew were there before. So my whole point is I'm in agreement with you. Like Neil's come on the show, and it does seem like a lot of these institutions that kind of make up the framework of modern life, there's starting to be more pronounced distrust. It's just hard to kind of see through to the other side,
I think if I were to make a inflation is always an everywhere statement, I would say, well, not always everywhere. Inflation is very often and almost everywhere a problem of trust. I think if you go to if you compare Switzerland to Argentina, why is there no inflation in Switzerland? Why Argentina has inflation? I think the underlying true reason is that at the end of the day, the Swiss trust each other. They trust the government. They trust that the trains are going to run on time. They trust that the supplier is going to pay them. They trust that their property is not going to get stolen. They trust that they're not going to be hit with some sort of tax out of nowhere. So as a result, because of this trust, inflation is very low. On the other hand, if you go to like Argentina or Venezuela, you don't trust anything, right? You don't trust that your supplier is going to pay you. You don't trust that the government. So you're going to mark up everything because you always expect the worst. And as a result, this is a structurally higher inflation economy because you don't have that level of trust. And I think as the US is moving from a high trust society where, you had one media, telling you that the evening news, you had a government that, generally, okay, like, think George H.W., right? I mean, George H. Bush, like the first one. I mean, no one really loved him, but we could all trust him. He seemed like a nice guy. Where you trusted science, you trusted your experts, and you trusted the schools, you trusted the medical system, and you see across every institution, any survey that you look at, this collapse in trust. Trust in Congress is very low. Trust in journalism is very low. Trust in science is very low. So all that is kind of a symptom of this breakdown.
So the secular kind of projection for you is a world of inflation. I really like the framing that you had there of kind of like America's moving from a high trust to a low trust type society. what are kind of the broader implications? Like, what should people be expecting in their kind of more broad day-to-day life over the course of the next 10 years? Like, when people hear this phrase of like building institutions, that's a very vague kind of word, right? We know how that happened in, post World War II. We had the Marshall Plan over in Europe. You had kind of the New Deal over here. There was investment in infrastructure. There were all these bodies that got created. What does that look like to build institutions? Like, how does that filter down into people's day to day?
Well, I would say that the happy scenario is the post World War II, right? Where you rebuild you had the Great Depression, what's that rot of the old world, and then you have this new social contract, rise in the middle class, build the interstate highway, GI Bill, and an insane level of consensus in terms of values. Which could be quite suffocating at times, right? I mean, the 50s were probably not a good time for everybody. But I mean, if I'm optimistic, I would hope that the same things happen. Like when, once we've gotten rid of kind of the old stuff that's no longer working. I mean, I can make guess of what I think would happen. I think probably universal basic income is going to be something that's out there. Changing the way we work, which certainly were accelerated by COVID, where you've seen, a much more flexible economy, a redistribution of population, maybe away from the big cities because of the work from home movement, changes in living arrangements as well. I think all that is kind of happening under the surface, and it will just become clearer and clearer as we progress. But I also want to stress the possibility that it can go horribly wrong. I mean, the US is somewhat lucky that, I know Australia is supposed to be the lucky country, but the US is also the lucky country. I mean, every fourth turning in the US has been for the better, right? I mean, there are countries where that process just doesn't pan out, where the institutions, the old institutions die and the new ones that emerge are worse than the old ones. I mean, Germany in 1930s, maybe Soviet Union, France. I mean, for a lot of countries, this is a very difficult process. So, we'll have to see how it unfolds. I think over time, I'm an optimistic. I'm an optimist. I think the US has tremendous ability to regenerate itself. It always has, and I am somewhat encouraged by a lot of the things that we are seeing. I think the inflation that we are seeing, no matter how painful it feels right now, is a sign that it's happening, and it's happening. I was a lot more worried 6 months ago when we had 9.1% inflation. Like there was a risk that would go, but if we can settle in that range of, so again, my view is structural the I star underlying inflation is around 5-6%, which is, by the way, what you'd find if you look at that service X shelter and X energy, which is the new thing. That's where it's at, right? 5-6% inflation, a decade of 5-6% inflation, would do wonders. It would basically halves the real value of debt, right? It's something that goes at 6% every year, halves in 10 years, right? So if we can keep it there for about a decade, we'll see a lot of the debt is gone, the student loan crisis is averted, and then actual leverage ratios will be a lot lower, so that then we no longer need to have this kind of lower rates feeding new bubbles to have new bubbles, but have actual real economic growth like we had in the 50s and the 60s, instead of this kind of feeding bubble after bubble.
Yeah, well said, Vincent. We've got to wrap it here, but thank you so much for your time. If people want to follow you, find out more about the good work that you do, or subscribe, what's the best way to do that?
So the best way is to become a trading client of StoneX. We're a global financial service firm, offices everywhere. We do everything: stocks, bonds, options, derivative, commodities, all of that stuff. So if you're already a client, ask your StoneX rep to shoot me an email and see what we can do there. If you are not, go to my Twitter page, Vincent Deluard, VincentDeluard. Pin tweet, there is a link. You click it, you can get a free trial. If you're institutional, we grant all of them. I'm very available on Twitter. I am very grateful. I've met fantastic, including the people of Blockworks on Twitter. I love interacting. I love the questions. And then, we can take it from the free trial. We have options, very low priced option for what I believe is, I know I try my best to come up with uh, original global macro thinking, which I think is really in short supply, and it's going to be increasingly crucial as we go through this cycle. I think you really need this kind of global macro roadmap. Otherwise, you get massacred by these, vicious counter-cycle rallies.
Yeah, and you know what, Vincent? Maybe we can just close. I think the kindest thing I can think to say is in an industry of people who claim to be, stand-up contrarians, you are actually a true contrarian and often stand right more than you're wrong. So, thank you very much. Really appreciate your time. We'll have to do it again soon. This was a fun one.
Thank you.
Cheers.